Good morning again, ladies and gentlemen. Thank you very much for joining us. We'll just give a few more minutes for more people to join us, and we'll be starting momentarily. Thank you again. Good morning. Good morning, everyone, and thank you very much for joining us this morning. My name is Jumoke Olanio. I head the Business Development Division at FMDQ Securities Exchange Limited. If you can hear me clearly, can I have just one or two people just drop a message in the chat box to say you can hear me loud and clear before we proceed? Can anyone just let me know that you can hear me clearly? If you just drop a yes at the chat box, that would be very helpful. Can my panelists hear me clearly?
Yes.
Yes, please.
Yes, thank you. Thank you very much for that confirmation. So, welcome to the Debt Capital Markets Development Project Retail Investors Webinar session. This is the second of the series. And the theme for today's session is on investment options in the Nigerian debt markets. We'll be focusing on two products, Treasury bills and commercial papers. So as you're aware, or as you may be aware, and even for those who are new, the Debt Capital Market Development Project is a market-driven initiative spearheaded by the FMDQ Group PLC in collaboration with key debt capital market stakeholders, few who have given us and be gracious to give us their time today, and we'll be talking to you about the investment options today. The program is designed to develop and implement market development initiatives that will transform the Nigerian debt capital markets into a world-class, properly functioning market by 2025. In line with the mandate of the debt capital markets project, specifically the investors, issuers, and intermediaries engagement and education subcommittee to create awareness, facilitate investors' readiness, and champion corporate governance, among others. The subcommittee commenced a webinar series for retail investors to educate and sensitize the market about Nigerian debt markets, how to access the Nigerian debt markets, the market infrastructure in that segment, the risk, liquidity, investment options available. And the ultimate objective is just basically extensively sensitizing retail investors on what are the available options out there to them in the Nigerian financial market today. The maiden session on the retail investment session was held in January. And what we did was set the tone and build a good foundation for this webinar series, because we focused on discussing the general overview of the markets at that time, what were the features, what were the benefits to you as an investor, how you could access federal government saving bonds. So series 2 is a continuation of that series. And as I had mentioned, we'll be demystifying the features, benefits, access, and risk, investment risk in two product papers, two types of products, excuse me, treasury bills and commercial papers. And I tell you, we have two very, very knowledgeable and experienced persons to do justice to these topics today. Treasury bills, commercial papers, and again, we'll also be looking at mutual funds. So we hope that with these sessions, and which we're having today and which we'll continue to do, bringing you and educating you and sensitizing you more and more on these various investment options, that you find them very insightful and useful. So once again, thank you all for joining us on this webinar. As I'm sure your participation in this session, it highlights and underpins your desire and commitment to contributing your quota to the growth of the market, and indeed benefit to yourselves as you participate in the Nigerian financial market. So without much ado, allow me to go into the first session for today, which is the investment options, treasury bills and commercial papers. And it's going to be taken by Mr. Tayo Onodele, the Managing Director, Financial Data House Limited. Allow me to introduce who this person is. Mr. Onodele was a banker up until 2002 September, when he decided to actualize his dream, developing treasurers and treasury departments by giving full attention to financial markets capacity building empowerment. His quest for bigger challenges and unfettered access to sound treasury practices fired his enthusiasm for high responsibility and better exposure whilst in banking. He was appointed at various times as the Market Risk Management Officer in FSB International Bank PLC, now Fidelity Bank, head currency trading in Lead Bank, which later became Lead Merchant Bank, which now later became Lead Bank, and head Access Bank Treasury in 2000. He served as a committee member of the Money Market Association of Nigeria, now the Financial Market Dealers Association, between 1999 to 2002. And between 2000 and 2002, he single-handedly anchored the in-house treasury training for new hires with unparalleled passion during his stay in Access Bank, making positive impact on the careers of the budding trainees. He has contributed valuably to the development and production of financial market modules in the Nigerian financial market. He plays an active role in harnessing relationship between the Central Bank of Nigeria and other regulators, market operators, via workshops and other activities that support actualizing the dream of the development in the Nigerian financial markets. He holds a BSc in honors in statistics, a treasury dealership certificate, and the Financial Dealers Association of Nigeria. He's a member of the Institute of Directors in Nigeria and an affiliate of the Institute of Directors in the UK. He's also an honorary senior member of the Chartered Institute of Bankers of Nigeria. Mr. Onodele is presently the Managing Director of Financial Data House Limited. Thank you so much for your time, Mr. Onodele. The floor is yours.
Good day, distinguished ladies and gentlemen. I hope you can all hear me. And I'm not necessarily saying good morning, because I do believe that some of us may be in other time zones, and it could be afternoon as well. So wherever you may be, thank you for joining us on this auspicious program. And I'll just be taking off from where Ms. Olani had taken and stopped, to say that our subquad in times past actually looked at various debt capital market products. And if my memory serves me right, I believe sometime in November 2020, we had actually taken time out to look at the commercial paper, but from the issuer side and the issues. So in fulfilling the mandate of our subco, we're trying to connect the issuer side with the investor side. So today, we will be focusing on the investment side of these debt market products, T-bills specifically, and commercial papers. And I do believe the second speaker will be taking us on the areas that have to do with funds, maybe how we can access and then the processing. So without much ado, And in order to be efficient with time, can we go to look at the outlines for today under this session or this segment? We will be looking at the overview of the debt market products, as you can see. By practice, I want to believe a lot of people will wish we raised to slide A where we have the inherent product risk, but I will say that we should all keep our powder dry because it's good we understand the features of the product, and then we can begin to talk about the inherent product risk because interestingly, one of these products has been deemed to be safe haven for investors, which we will look at. And as Jumoke also mentioned, today is to demystify any myth or whatever we might have been hearing. So we'll say that there should be a little bit of caveat in terms of saying that this product is a safe haven, I mean the treasury bills. And also for the commercial paper, there is probably reticence from the retail end or some investor types also. The regulators may have some apathy for investors going in when you talk about investment protection. However, we do believe in the financial markets that if we all play cautiously and we calculate the risk that we're taking, chances are we'll all be fine. But perhaps when people decide not to be disciplined, we could have issues or challenges. And again, I'll go back to the mandate that we have in our subco to ensure that people make informed investment decisions such that when we have knowledge, when we have awareness, we can together deepen our markets, especially for the debt market products and even other products, because there has to be a connect. So if there was no issue of commercial paper, there was no issue of the treasury bills, investors will not have the opportunity to invest in some form of securities. All right, so let's move to the next slide, please. So the Nigerian debt markets presents a platform for us where we can have bouquet of product options where we can invest in as market participants. So as I mentioned earlier, you can see that we have itemized or highlighted the T-bills and the commercial papers. However, I think part of what we need to do today in the sense of so that we can begin to make informed decisions as we go along will be to look at the features in some of these products. But we decided to singularly pull out two because it will be too much to say we want to overload all the products. And I believe in times past also, we've taken some critical look or X-ray into the bonds, including the FGM bonds, and also when we talk conventional and non-conventional. And I believe going forward, we probably will be X-raying more of these bond products towards making sure that the investors are able to see variety in the market and can make informed decisions and have options in terms of the vehicles they use to perfect their investments as we roll forward. So today, I will be focusing on T-bills and bonds, okay? So what are T-bills typically? Like I said, we need to know these products. If we do not know a product very well, it will be futile in trying to make an investment decision in it. So we will try as much as possible. It's an awareness cum light training, if you want me to call it that. So T-bills are usually termed as short-term discount securities. And usually, who issues the T-bills? Central governments. In our jurisdiction, it goes to the federal government. So there is no other entity within this financial system or this economy or this entity known as Nigeria or jurisdiction that will issue treasury bills other than who? The federal government of Nigeria. And by and large, in jurisdictions, we always believe the sovereign is tagged to have what? The best risk you can have in the system. And usually where things are working well, as you have it in an orchestra, you would typically believe that if we see the body language or where the central government is operating, all other players in the system can decide to price their risks from there. We had a nice example sometime in the late 2000s where the federal government had to go back to issue the no specific need for that, other than for it to create a benchmark such that when Nigerian corporates or entities should go into that market, which is the offshore market, to raise capital, it will be easier for it to be priced off properly, objectively. But if federal government had chosen not to do that, it would have been a bit difficult for corporates to access capital from that market. So let's come back home. And as much as possible, we're going to be, cruising into Nigeria, not because it's only in Nigeria we have T-bills. Yes, there are T-bills in different jurisdictions, but we're bringing it home such that our retail investors can begin to also see that maybe perhaps there are some things that they needed to have some insight into and they never got it on the surface. As I mentioned, knowledge is key and knowledge is power, as they say. If we have more knowledge, there'll be more awareness and participation in these debt market products. So in Nigeria today, we have 3 benchmarks, as you can see there, 91, 182, 364 day benchmark. However, was this where we started off from? Not exactly. As in, did we have the 3 benchmarks, same time, same day? Not exactly. So when we go into the market trend, I will try and touch on some of these salient milestones that are happening in the lives of these 2 products that I'll be extracting today. So pretty much, instruments like the T-bills do not pay you interest, as the regular investor would seem to say. If some instrument is not paying me interest, why am I investing in it? But the truth is, when we have knowledge, we do know that because we said there are discount instruments, the difference between what an investor puts down to buy this investment and what it gets at the end of it, simply put, is the income made in the course of the investment. So, like I said, the T-bill may be deemed to say it's a safe haven when you invest in it. But will it necessarily provide the investor with the highest yield in town? The usual answer is no. But sometimes, depending on the objectives of the investor, the T-bill might just be for many, which will make me now say, if you look at the features of the NTBs, every feature we've listed, there are 5 of them, may not necessarily tick every investor's box to take that decision. However, what you want to play with is the risk, and also, will it give the comfort? I believe investors are always looking for comfort as much as possible, depending on the individual's risk tolerance. And also, sometimes it's all about stability and the fact that we want our principal back, that capital protection, which is usually why T-bills bonds are usually tagged to be safe haven when you invest in them. But as I noted as we started off, that has to come with a caveat, because it is not every time that these instruments become what the safe haven. And I'll tell you, so like I said, don't be in a rush to jump into conclusions. For the investors category, we do know, I believe some of them may be in the house today, but the focus today will be in that retail investors box, because that is where we believe we need more representation, more participation to further deepen our markets. Because if you ask me today, a lot of corporates are already taking part in the Nigerian T-bills market, and perhaps even some may be taking part in offshore markets, depending on their portfolio and what they are doing. And also for the banks and other financial institutions, I want to believe this is their regular products to manage the short end of their, the low end of their risk or liabilities they are managing. Let's go to the next slide, please. So let's now talk about the commercial paper. As this is a very special period, not because it's difficult to understand or it's not available for investors to go into, but because if you look at the checkered history of Nigeria, it's a product that had been bastardized in the market. When I say bastardized, by professionals who are supposed to have been entrusted with the product. And I would keep most of the comments to where we go into the market trend, because were it not to be for the central bank in 2009 and the FMDQ by 2014, what we have today as a CP market that is showing signs that it wants to be deepened and grow may have been impossible, but we'll get to that. So let's quickly look at its features also. Like I said, similar to the T-bill, is the major difference is that these CPs are typically issued by corporates. Back in the days, they would talk about blue chips. So I don't know how many companies can be tagged as blue chips today, but I believe maybe FMDQ is helping to add some blues to the market, if you deem it so, because it has decided to look at the governance around the commercial paper market. Remember, I told you, if you were in this market, or for those of us who have had a bit of history, this was a product that was bastardized that investors may not know the quantum of it in the market. Even an issuer's name may be periled in the market as having commercial paper, where in fact that entity never ever issued the commercial paper. So we started seeing some semblance of transparency and comfort or confidence coming back with FMDQ coming into the play of things. So like I said, similar in terms of the treatment, but you cannot accede the kind of comfort level you would give to a Nigerian treasury bill or a treasury bill. Because speaking generally, T-bills, like I said, are issued by the central government, whilst commercial papers are deemed to be issued by what? Corporate entities, who are supposed to be your regular blue chips back in the days. But some blue chips we knew are no longer available, not to talk of whether the color of the chips has changed from blue to whatever. All right. But if you look at how to price it, if you look at how to treat it as much as possible, it goes in tandem with the way you would typically treat a T-bill. So I think it's the risk profiling that is a major distinguish, and the fact that this type of securities are based on unconditional promises. Do you want to underline that in your mind? Promises, back in the days when we were young, people would say that promises are made to be broken, but not in this case. When you make these unconditional promises, the corporates are expected to abide by it. The major issue you don't want in a commercial paper is default, because where there is default, then the regulator is not going to believe it's business as usual. Investors will not be protected, and that is not where we're going, which is why some issuers have decided to add some sweeteners in addition to whatever comfort or features that the central bank brought in and that FMDQ has accentuated to another level for the product to have some level of comfort. And I believe as we roll by, chances are the market will continue to gain depth. Okay, so let's quickly look at some of the features, just like we did for T-bills. Investors usually pay the usual net of what discount. You can see it's the same thing, the same way we describe with the T-bills. All right. The discount rate for the T-bills will usually be higher in a normal market situation than what you see for T-bills. And why is that? It reflects the higher risk factor. Why? Like I said, central government is usually expected to have the best risk profile in town, except in a situation where the government is no longer respected or is not behaving at the level it's expected to show the way as an index could be, where others will now tread and follow. But were things to be proper and reflected properly, then you will see that the yield for the treasury bill will be relatively lower compared to what a commercial paper will be in the market. A similar product that is in their league could be the one you call bankers' acceptances. Yeah, it's not the focus for today. However, even at that, you might be able to see a little bit of discounting further with a BA compared to a CP. However, a CP now does something to make it arrive at that same level or respect you can accord a BA. And that is the issuer decides to add what we call the guarantee. So which takes me to that next point. Issues may be guaranteed by banks. If commercial paper issue is now guaranteed, simply put, is saying that investors should have comfort, that should the issuer not be able to pay on the maturity date, somebody is standing firm to ensure that that obligation is settled. And if you listen to what we had mentioned earlier, or if we can check the heartbeat of every investor, what you don't want is for you not to receive your principal plus whatever income you have made. So a guaranteed commercial paper will accept, will come to the same footing like a BA, where that guarantee is there. But of course, once that guarantee is there, that means the risk profile also is adjusted, and the yield that the regular investor may be looking for may not be there, because somebody is now saying, if the issuer does not own up to the obligation or honor the obligation, I will take care of it come that redemption date, okay? And the beauty of this product is that whilst it gives, one of the benefits for the issuer is under a CP program, which the FMDQ has helped us to define for now that is a 3-year plan, similar to how you issue self-prospectuses. That could be a program where the issuer comes out at different times rather than coming with a bullet request in the market or looking. And why is that? Number one, it helps the issuer to probably access money at different discounts or yields if you want to really benchmark to money or other types of loans. And without this product, that would have been impossible. You would have had to be going for loans at different. So what you've done is to secure an approval, and then you access the market at salient times you believe you could be able to meet your objectives. Because for the borrower at any time or the issuer, it's always about getting money at low cost, and whilst for the investor, you want money at high yield, okay? And the beautiful thing that I see, which the retail end enjoys from products such as this and the T-bills, is the fact that their tenors typically, or the days to maturity of the T-bills, if we're going to use appropriate terms, is stretches within a year. And I think more of the problem we see with the retail end is that the future always looks bleak, and most times they are reticent to go beyond the 1 year mark. So what this does is you can have those short-term investments made, and it also helps you to test the liquidity of the issuer, where he's able to pay, unlike where is a long-term and you are not sure whether the corporate will still be available to make the payment. So to further safeguard and be sure that people who are knowledgeable enough are investing in the CP, the FMDQ haven't come onto the surface as an SRO to take charge on the CP market from where the central bank had walked up to in 2009. I decided to say, what we will do, typical to when something has been broken and you want to fix it, you don't want to go straight to extreme. So you want to build cautiously and test confidence and all that. And I think so far, so good. There hasn't been such challenges since around 2012 when we started seeing reissuance in the market of CP. So FMDQ, actually under the investment category or investors category, has said that there will be two major classes, which is the qualified institutional investors and the eligible investors. However, the retail can come in at some point, only where, remember I talked about where the guarantee is, to further ensure that they are protected. But even at that, you still will expect that anyone that says that they fully understand this product must have gone to execute a declaration at testing. That is under the eligible investors, that they fully understand this product, the risk inherent in it, and so their decision on investment is well informed, okay? Which is part of what we're trying to do today. But be that as it may, I believe there are also retail people or investors you could classify as being in the retail end who would like to participate in these products. And that is one of the reasons why we are sharing insights and trying to share knowledge on this, to say, what are the ways that can come, that these people can also enter into, because if there's no guaranteed commercial paper in issuance, does that mean the retail end will not be able to benefit? So that's one of the things we probably will talk about. Okay, let's go to the next slide, please. You may wonder, okay, who are the major or key stakeholders in the market for the T-bills and CPs? Like I said, both products similar, but issuers different, risk profile different. But because there are products within the market, certain things may happen that you can easily, say that it can be aligned to each of them respectively. So I will just give you a second to digest this and see the layout between when we say FMIs, the CMOs, the capital market operators, and who the market participants typically are. Of course, investors, by and large, covered at the bottom over there. Issuers will be there. So you have for the T-bill, there is only one issuer in each jurisdiction. But again, investors, from individuals to corporates and even government agents, that they can invest in T-bills. So usually, like I said, in the beginning, there wasn't so much of transparency with the commercial papers until early 2012, 2014. And this was further made clearer by the time FMDQ came into the market and showed us the CP quotation process, where it had now shown even the process flow from the point of investing, or from the point where there is a commercial paper issue coming to the market, when an investor goes into it, custody happens and all that. Back in the days, while some of us were still in the interbank market or the banking industry, you couldn't see this. And what was it like? I'm sure what used to happen was a bank that needed liquidity could just start to knock out some commercial paper notes. As we know, there has to be commercial paper notes, which signifies the securities of the loan as evidence by the issuer. And where there is no third party that can guarantee, I mentioned to you, an issuer might find out that his commercial paper is being exchanged in the market for liquidity, and the issuer is saying, we are not issuing, the perceived issuer or supposed issuer debunks that and say we have no such commercial paper in the market. It has happened. And I believe some of this gave the central bank a lot of headache and splitting hairs, which is why, for the regulator, they want peace in the market as much as possible. And as I mentioned, until some people decide not to be disciplined, then there'll be a problem. Because everybody wants to be liquid at all times. So we had issues. So by 2009, there was even a time in this market that when the central bank governor came on board, the first part of the first circulars that went out was that banks should bring all commercial papers and BAs on balance sheet. By treatment, naturally, the BA, the CP should be off balance sheet engagements, except where the banks or where the banks have invested their own monies into the issues. So, because yes, some banks use these products to manage their balance sheet and to also manage liquidity, which sometimes became fraudulent. So at the time, it was as if the central bank had thrown the baby away with the bad water. But there was genuine need, continuously genuine need for this commercial paper product, especially. Because by the time we started looking at market trend, there was actually no time that you could say, oh, the T-bill market suffered. And to make matters interesting, the central bank got its T-bill market right by having what you call the money market dealers, primary dealers. And once those were in place, the underwriters you see there, where we say applicable, then was in place. So no offer will fail, because whatever was not taken at subscription level or was not allocated at marginal rate would be sold to these primary dealers, which we know in Nigeria as money market dealers, on a pro rata basis, and they were given some form of reward, whether it was economical or market driven to them. They are the ones that can say that, but voluntarily they decided to apply for the licenses. Okay, so just as a note, we now believe as of today, anyone that is investing in these two products will have the securities lodged with a depository. And that gives you comfort, because if I remember, and my memory serves me well, sometime in this market, some banks that went down and under took, and some discount houses took some investors' securities down with them. Such would not have happened while the securities invested in on behalf of the investors had been lodged in a depository. Because for somebody to use your security that is well lodged in a depository, the person, you would have had to give instruction. The only time you don't need to give instruction will be when you are the issuer is redeeming, and then the money flows into your account that you have nominated. Okay. So to give it structure, FMDQ also then said there must be accountants involved, rating agencies. Central bank has said there'll be rating agencies. So central bank also talked about depositories, but the FMDQ helped us to really clarify how to go and what each role was going to be and all that. So it became clear. That's why I kept saying the transparency began to come back. That market and confidence was restored to show us what we're having today, which is near a 1 trillion mark in terms of issues. And of course, because of the short-term maturity in nature for the commercial paper, you would see that it would not have been easy. Some of them would have been running off compared to where you have bonds, which are typically your regular long-term investment. Next slide, please. So the three major regulators giving oversight, we've seen them there. So kudos to them. Now, to quickly talk a bit about history in terms of the market trend analysis and to show some level of statistics, you also see that the T-bill, because of federal government's might, had actually been in place since 1960. The first T-bill issue was at 4.5% per annum discount by way of history. And at that time, issuance was monthly, then it moved to every 2 weeks, and then now weekly. So over the years or decades, we have seen different issuance style, and right now we are on fortnightly, every 2 weeks. And typically, what are they? They use the T-bills in issuers as a central bank and federal government with DMO, who's managing the debt portfolio to manage the short-term budget deficits of federal government. So you might be wondering, when you look at that second box that talked about the 182 and 364 being brought out in 2004-5, so which was like how many years? 40 something odd years after independence. So this country for so long was using a 91-day bill to manage its obligations. That's a big mismatch, if you ask me. But we went that way for so long. But the 2000 to now, or the early 2000, if you ask me, will be when I felt Nigeria's financial markets decided to retrace a step and be on the road to success. We had so many beautiful things happen around that 2003, consolidation, bond issuance, federal government coming back to the market, the proper DMO in 99. So then, we had pension fund, pension reforms in 2004. So that was the beginning of our market trying to show stances of getting deepened, and we could start talking about long-term investment products. I remember around 03, 04, when we were training in the market, if you ask anybody, what rate would you give Nigeria money for 5 years? Nobody will even say anything because it was bleak. Well, one thing that was interesting is that today, people are eagerly willing to lend to the government for 30 years or the country and beyond. I'm sure some people, if there's a 50-year issue today, there will be people willing to invest, whether locally or internationally, okay? And then to tell you how bad the issue on BACP had been, in 1997, there was actually a circular, which most people may not know, but by way of history, we're able to dig that out, where the central bank had to write to tell the banks, their external auditors and discount houses on how to treat use because of what? There was a lot of misuse, misinterpretation, balance sheet management, which was unorthodox going on. And even if you look at the current guideline from the CBN, you could still feel that in what's going on. Central bank that had not been happy with banks, especially and discount houses, in the way and manner that utilize this product. And at the end of the day, it would have been the innocent investor that would suffer. So it got to a point that it was emphasized that the banks needed to let every investor know in which commercial paper they were investing, because banks just will keep that to themselves and then take deposits and just use it to match the commercial papers that were not real commercial papers, if you know what I mean. So again, it goes back to knowledge. Were investors sound enough to understand that little ingredient, they would have asked or challenged the banks to say, I want to know the issuer you are putting my money in. If it's not convenient, or if it doesn't meet my risk tolerance, I don't want to put my money in that. I'd rather leave it as deposit, or I'll look for another investment. But the bankers had the powers to do what they wanted to do. So again, this continued. So as I mentioned, in the 2001 to 2010 range, we had lots of beautiful things happening in the market that started giving our market some good semblance to the extent that, it started attracting offshore parties because we needed to create standards. And one of the beautiful things was that our T-bills that were maturing 3 different days, some on Thursday, another one on Friday, another one on Tuesday or Wednesday, were synchronized. And at the same time, we could implement them on the T24, which was the settlement system that was being used then. And being on an electronic platform kind of made it easier in terms of operational and dynamics. And to make it interesting, over 40 years again, all that happened was primary issue and then nothing. The only times that you see transactions will be maybe in the interbank community is either you are the discounting or whatever you. So there was no active and structured secondary market until 2007. It might interest you to know that the bond market actually started trading two-way code before Nigerians or the market could be interesting. We started trading the long end of the curve before the short end of the curve. Nothing stops us someday from being able to have a very, very liquid market for commercial papers as well. But the CBN had actually issued a refined or revised guideline on the issuance of CPs by 2009. And I believe that FMDQ came on the surface after. If you look into the next leap, and to then say, like, that's why I said it's now become the dawn of a new era, because the transparency that was not around, or the opacity that we used to have, was going to go out. Because if there is a 1 billion issuance, for example, from an issuer today, you can't have more than that 1 billion. But back in the days, you wouldn't even know. It was like between the issuer and his issuing house, or the IPA, if you may call it that in today's parlance. And such information memorandum may not be available to the public. And also, nothing was stopping some professionals from saying that 1 billion CP was actually 2 billion. Who will vet it? Who will say it is not up to? Unless the issuer complains. So if the issuer never complained, sometimes these notes may have been signed in blank, in trust. And then when you see it, you, as an investor, you will believe that truly such commercial paper issuance existed. But I want to believe with the FMDQ's operation, all of this are fizzled out now, and we are beginning to see seriousness in the market and a huge amount of transparency. And to date, you also see that since FMDQ has taken charge of that market without the CBN abrogating its powers, everything is still on the heels of the guidelines provided by the central bank. You will see that there has been, good performance so far, and we are hoping we can maintain that, and then the market will continue to deepen. So, which brings me to saying, if you look at it, the T-bills is almost looking like it needs no further thing to be seasoned. It's already working well. There's primary dealers or money market dealers in place. If the offer comes out, it will be underwritten, which you could say is guaranteed, kind of, right? But we don't say that it's guaranteed, but you have the federal government might. So when we get to the risks area, we will look at the comfort zone there. But you can see, for me, the CP is the toast of the town today, because back in since 2014, where we started seeing new semblance, we had 3 issues, and now we're beginning to see 100 issues as of October. And I believe also by now, it is not impossible that some prospective issuers in the market. What is informing this? More awareness, the quest to be able to see opportunities to raise money at a decent rate, and also the governance brought into the market and the transparency by FMDQ. So, however, a major hindrance to this could be for an issuer is where yields have gone up, like what we're having in the market today, where inflation has also trended northwards. It may be a cautious time for the issuers to come out. But it then takes me to that next point to say, you are seeing corporates raise money in this market within that time period as low as less than 6, almost 6%, and as high as 18.18%. Of course, it's market driven. And it gives a diversified base to the issuer, unlike just being with one entity, maybe a bank lending them such money, or a few banks in a consortium or syndication. So it's a lovely product. And honestly, for as long as there are good issues, some retail has to go into it, probably for the guarantee that will be there. And chances I might give some more yield, but of course, the major thing is to ensure that we don't lose our shirts in the process of targeting those yields that we like. But look at it, I'm not sure, other than maybe the FGM bond, which, I mean, anything federal government enjoys high patronage. And of course, it's that risk profile, right? You remember when the FGM bond came back, well patronized up until today, but the corporates cannot say, the same cannot be said for corporates. So who are the people issuing CPs? Corporates again. But if you look at it, I think the commercial paper market has done nice, decent in terms of growth, and it's given a circa 13x in terms of growth. And I'm sure chances are we'll see more issues. Again, the yield at the current level may slow that down, but it is not impossible. Next slide, please. So let's quickly look at the benefits that come from these products. And because I said the treatment of these products similar, the major thing different is the profile of the issuers, or the risk profile. So for the T-bills and the CPs, short maturity profile, which is comfort for retail investors, because to step out is like being told to go and do a 30-year investment as an individual. That could be very touchy or sensitive. So typically, retail investors are comfortable at the low end of the market, as we typically say. And now, the beauty of this, or you are an investor in them, it could present you with an opportunity. Happen. There are times as individuals or as retail people that we end up needing liquidity. If we are holding this kind of product, chances are we could negotiate them to access liquidity, or perhaps we see an opportunity to enhance the returns we have. So imagine you've bought at a particular level of yields or the discount, and then yields trend downwards, and you say it's time for you to make money. You might enhance your yield based on your holding period, okay, for the T-bills and the CPs. Like I noted earlier, the T-bills are deemed to be risk-free. And this is nothing other than the fact that, yes, it is the federal government that issues, or the sovereign or the central government in every economy. It's always believed that the government will be in continuum, unlike a corporate that can go down and under easily, okay? So the fact that you can get upfront income is good for you as an investor in both products, because you only need to put on an amount, and then you get what we call par at the redemption date or the maturity date of either of these instruments. And that's the difference in that, as I mentioned earlier, is implicitly your income. And so usually, if you offer you low yields for T-bills, and you know why, when you are not taking high risk, chances are you won't get high returns. So if you want to be comfortable, just chilling, you don't want stress, maybe the T-bill is what to go. But of course, you may not be able to be proud to have the kind of yield that your neighbor will have for having invested in a CP or other high-risk products. They are deemed to be usually liquid, despite the fact that I mentioned that we only started having the money market dealers in 2006, 2007. We still would have had an opportunity to use this to raise money by discounting back in the days. It wasn't easy because it wouldn't profile you or present you a transparent market, unlike now that you can easily see what price maturity you're looking for or whatever you have left. So usually highly liquid because of, I hope you can hear me. And then eligible securities for repurchase contracts. So for some reasons, some investors will have these instruments to hold because it gives them another way out to be used should the unplanned happen. The same thing for the commercial paper. Chances are where the holder is not going to be able to run the race or gets tired along the line. Imagine an investor goes, thank you very much. Imagine an investor goes in all the way for maybe close to 270 days, and maybe after 4 months, sees that it can no longer go, and the yields in the market are quite interesting. It presents a way to go out, or even be used as a collateral to go to whatever economic activity or borrowing in another product, such that when it's redeemed, then the process can still be coming, and then it doesn't affect what has been earned on that. But then the money that was accessed would have been used for some economic activity, and we can look at that one-on-one. So it helps, and I think it would give some retail investors some opportunity than just holding on to maturity or other investments that locks them in completely. So that is the bit I can quickly share on benefits. Let's now look at the next slide, please. Let's try to quickly talk about the risk inherent in these products, because as I said, the T-bill will always be deemed to be risk-free and safe haven. But we do know that, I'm not sure, but I mean, in Nigeria, it has not happened for T-bills. And also in some jurisdiction we have had of the central government defaulting on its obligation. However, it's never happened. The simple thing to do, I mean, maybe two things quickly available. You can roll over by reissuing securities for the same tenor, which you can't do easily with a commercial paper now, just to be sure that there is capacity to avoid any misconception. But the government has its way out, or they could print more money if they wanted to do. Of course, it has consequences. Sometimes when you even look at the calendar for the T-bills issuance, you could tell that a particular T-bill that is supposed to be redeemed is being reissued again, but nobody has had issues reinvesting. Again, federal government might is big, no matter how you say it for today. So now, one major thing that will not give the investor that safe haven feeling is if you do not run the race to the end, as in you don't hold till maturity, chances are what? You may not meet your par value or that future value of 100% of what you put in. Reason being that you will be exposed to price risk, or what we call market risk, because it then means you will have a security to sell before the redemption date. It is only when you hold it to maturity that the redemption price you get is 100. So that is very key and important. But for any investor that runs either of these or these two products in their portfolio and will hold to maturity, they will always make the par value. So, but for risk managers, other issues can start coming in. You may be holding an instrument at the detriment of your organization when we start talking about economic value and all that. But that is not for this situation or this segment. So for the CP, likely the same thing. Usually people hold to maturity. Market cannot be deemed to be as liquid. Imagine from the statistics I showed, 600 billion to something of 3 trillion. It's not the same. But with time, nothing says that our secondary market cannot be liquid, and you start seeing lots of entities showing two-way prices in commercial papers. That kind of brings some transparency also into the pricing. The fair value comes in because, as I keep saying, the secondary market is where you get a fair valuation for financial market instruments. So really, capital may be eroded if you buy this product, if also you do not hold to maturity, or perhaps the time you decide to venture into the secondary market, yields have gone high. So with what we are seeing right now, some people will be holding CPs that should they be trying to get rid of it because they need to access liquidity, it will probably not return even the kind of capital they put in. So those are some of the risks that you need to. There might be other risks, of course, but again, as you say, caveat emptor, as the lawyers will say, buyer beware. So it is not in all cases that you see safe haven in T-bills. But the beauty for us in Nigeria for the T-bills is ever since we've been having change in government, coups here and there, no new administration has come and said, out with the old. We are starting to build our debt profile afresh. So whoever lent to the previous government, they're on their own. That has never happened. So there has been continuity with government, which is what government is all about. So there has been continuum, and that gives comfort. But if that is tested, trust me, a lot of issues will come and people will not be, subscribing to these T-bills the way so other products from federal government. So basically, I think I should stop here to give the floor to the next speaker, and then maybe if there are questions, we can also take it. And I hope I've been able to not make it complex and make it simple for our listeners. Thank you very much.
Thank you so much, Mr. Onodile. I think they say knowledge is power. So the question is, what is your risk appetite? What is it risk you're pursuing? Is it return you're pursuing? Or is it a balance of both? I think we've been able to present to you two products today that can help you address that and may help you make that informed decision. But let's go on to the next session where we'll be looking at mutual. Sorry about that. We'll be talking about the investment process, how you can access and what platforms you can access money market mutual funds. And we'll also be looking at risk and mitigants in these type of products. To do justice to this topic, we have Mr. Ike Mokwede, who will be talking about this. Allow me to introduce him. He is current president of the Fund Managers Association of Nigeria. And a bit of his background, he has over 22 years of experience as a diversified financial professional with expertise in wealth management, corporate banking, treasury, and capital market transactions. He began his career in Fidelity Bank, where he worked in various capacities as retail banking, private banking, commercial banking, public sector, treasury, and funds management. He later joined NBC International Bank, where he rose to become head of the construction and real estate and investment banking unit. Afterwards, he joined the corporate banking directorate of First Bank of Nigeria PLC. He then moved to Marina Securities Limited as director of the wealth management and business development, and later joined Coronation Merchant Bank as head of Coronation Capital Markets Division. Following the divestment of Coronation Merchant Bank from the asset management subsidiary in June of 2019, Mr. Omakede was appointed as the Managing Director of Coronation Asset Management Limited. He holds a bachelor degree in business studies from the University of Buckingham and is an associate member of the Institute of Directors of Nigeria and UK. Thank you very much again for joining us today. I give the floor to you.
Thank you. Thank you. And thank you, Mr. Anadele, for, I hope you can hear me.
Yes, we can hear you.
That's thank you.
And thank you again, Mr. Anadele, for giving us that very brief, well, not very brief, but that very interesting and deep speak on T-bills and CPs. So today we'll just be speaking about mutual funds, but really we are speaking more about money market funds, which really relate to what we are speaking to today. And these are funds that are really meant for the retail investors. So if you just, I'll just briefly give you an overview of the FMAN, and then we'll take it from there. So Fund Managers Association, or FMAN, as we call it, was established to promote the operations of fund managers registered by the Securities and Exchange Commission in Nigeria. Our mission is to be facilitators of public policy advocacy, education, regulation compliance, market promotion, and international best practices for our members and of our members and investors. The vision is to remain the most effective voice of fund and portfolio managers in Nigeria. So what are we? We're self-regulation and supervision. Self-regulation and supervision of SEC-registered fund managers is what we do. We ensure the observance of global best practices relating to the operations of fund management in Nigeria, and we educate the public on the investment and operations of our members. All right, so far, FMAN is comprised of 190 members and counting. I can assure you that every other week we get requests for new membership. We have a total assets under management of 6 trillion. While you think is great, if you compare it to that of the pension industry, you realize that there's a lot of room for us to grow. We have 37 members managing 139 registered collective investment schemes or mutual funds, including the infrastructure fund, ETFs, and we have a total net asset value of actually is just shy of 1.5 billion or trillion as at September. Since inception in 2009, the total number of registered funds has grown by 239%, from an initial of 41 to 143 funds as of October 2022, and our total net asset value of the industry has grown by 1,362% within the comparative period, from 98.9 billion to about 1.37 trillion in 2002. Next slide, please. So this is just speaking to the net asset value, which I'd spoken to. I think time permitting, we don't really need to speak to this. And this also lists the types of funds we have. We actually have a total of 10 funds, and this is speaking to net asset value per fund type from 2017 to 2022. You would notice for eagle-eyed investors that we don't have certain funds here, which include the ETFs and foreign funds, but they are also inclusive. I'll try and just speed it up a bit so that we can go to Q&A. Next slide, please. All right, so according to Section 153 of the Investments and Securities Act, ISA 2007, mutual funds, also known as collective investment schemes, can be defined as a scheme in whatever form, including an open-ended company, in pursuance of which members of the public are invited or permitted to invest money or other assets in a portfolio. So it is a type of financial vehicle made up of a pool of money collected from different investors, both retail and corporate. And the aim is to invest in securities like stocks, bonds, money market instruments, etc. These funds are then managed professionally by fund managers and regulated by the Securities and Exchange Commission. So the total assets of all regulated open-ended funds in Nigeria decreased by 11%. Not in Nigeria, globally, decreased by 11% from 59 to $59.9 trillion. This includes funds of funds, and this is as at Q2 2022. Funds of funds means funds that are invested in other funds or invested in multiple funds. Similarly, a global net cash flow to all funds was $130 billion in the same period, compared to $79 billion in Q1 2022. So on the right, we have given you a brief view of the fund managers, 119, all this I've spoken to, but it's important to note that according to a report from PwC, the global funds industry, which includes pension funds, is projected to massively grow to 149.4 trillion by 2025. This is a huge opportunity. Clearly, people are seeing the opportunities in investing and saving, and that is why this is so. Next slide, please. So let me just briefly speak to features and benefits of mutual funds. So every mutual fund is administered in line with a trust deed. Trustees represent the interests of unit holders in the trust deed, and unit holders are domiciled with a custodian bank. Well, the funds of the unit holders are domiciled in a custodian bank under the overall supervision of the SEC. With collective investment schemes, investors with as low as 1,000 naira, this is important to you, especially retail investors, investors with as low as 1,000 naira, depending on the fund, can invest in mutual funds and enjoy returns through pooling of funds by a fund manager to invest on your behalf. So the benefits are liquidity. We can't say how good liquidity is, because what liquidity does for you is that liquidity makes it it makes it easy for you to come in and out of funds, and you mitigate the risk of having to not come out of an investment at the right time, because you are now pooled in your investments are pooled in a security, and so you don't have that reinvestment risk as an investor or loss of funds. Low cost, because it's affordable way to invest in the wider scheme of things. Higher returns, because the investors can you get higher returns than you typically get higher returns than you get in on your own. Professional management from an experienced team of professional or fund managers who set the fund strategies, do the research for the investments, and monitor performance on your behalf while you sit back and you can go about your own various businesses. Diversification, because by diversification, it allows for several asset classes and different allocation within a fund, and it gives you better returns and better opportunities for diversification. Of course, it's very convenient and it's very transparent. It's transparent. Please, it should be noted that every mutual fund is regulated by the SEC. Next slide, please. Okay. So now we're speaking to the structure of a mutual fund. So if mutual fund starts with the investors, which is, I presume that a lot of us on this call are investors, and it comes to we pull in your funds, giving to a fund manager to manage. The fund manager invests in securities which generate returns by way of capital growth as well as dividends, and the returns are distributed to the investors. Now, just very quickly, parties to a mutual fund. The first party to a mutual fund is, well, really technically is the sponsor, but I like to say is the investors. Investors whose savings for the investments are looking for proper investment channels for their savings. And then we have the trustees. Now, this is quite important that I say this. So trustees are appointed by the sponsor of the mutual fund, not the investors, with the approval of the regulator, in this case, the SEC. And at least 2/3 of trustees must be independent. So the trustees have the fiduciary responsibility toward every unit holder, and they receive fees for that service. And then we have the fund managers. The fund managers are the asset management companies that manage the funds. We've spoken to that earlier. And of course, they charge you a fee for managing the fund. They are, of course, they manage their funds in different mutual fund schemes, but they are accountable to the trustees, and they charge their management fees. Then you have the custodian bank. Now, these are appointed by the trustees, and they keep records of securities, investments, as well as the cash that comes in your funds. And of course, then we have the registrars, which are transfer agents, and they issue, redeem, transfer units of the mutual fund schemes and keep the investors' accounts up to date. So they are also registered by the regulator. Next slide, please. So I'm not going to go deeply into this, but this is because we're speaking really to the money market funds. But these are parameters for mutual funds in the industry. And we speak to the underlying assets, which in the case of money market funds will be treasury bills, commercial papers, and bank placements. It's different for the different types of funds that we have. We also have the investment objective of the fund. So in the case of, you can see in the case of money market funds, is to seek capital preservation and maintain a high degree of liquidity, which is different from a fixed income fund, for instance, whose underlying assets are bonds, and they seek to generate a stable income by investing in the diversified pool of debt securities in Nigeria. So the risk profile. So risk profile for the money market fund is low. In fact, it is possibly the lowest risk profile in the fund management industry for all the types of funds that we have. We have time horizon. Short-term horizon for the money market fund is 1 year, and the income distribution, which typically, even though it's stated in trust deed for money market funds, income distribution is quarterly. And of course, we have the total expense ratio. The total expense ratio is the total amount of expenses to the investor on the fund, which include all costs, all fees, all costs that, including trustees' fees, the fund manager's fees, the registrar's fees, and so on and so forth. And it's 3.5%. Now, I don't know if we're going to share the slides with the people on the call. So I think maybe if we are doing that, I don't really have to speak to the other funds, since what we're speaking to is the money market fund. However, I think it's also pertinent to say that there's, for you to understand a mutual fund, of course, apart from looking at the trust deed, you should look at the fund fact sheet. Now, this is an overview of a fund, which includes the objectives of the fund, the risk levels, the costs, the past performance, and the holding details of the funds. And it's pertinent for you that in choosing the kind of funds that you want to go into, you should have a look at the fund fact sheets. Now, fund fact sheets are typically published on a monthly basis and are online and free for all. So they are the most timely and efficient tool that investors can use to learn about a fund. Next slide, please. So again, I don't really, this is just speaking to the equity funds, the dollar funds, and Sharia compliant funds. I said that maybe we should skip all of this so that it gives us enough time to take Q&A. So money market funds. Money market funds are funds whose underlying assets are treasury bills and commercial papers, and of course, bank placements, which Mr. Anodele has properly schooled us about. And the investment objectives is to seek capital preservation, steady income, and maintain market liquidity. All right, so money market funds are suitable for short-term focused investors seeking low-risk investments, which is typically the typical Nigerian investor who is looking for short-term investments and is looking for low risk, even though we always want higher returns at the lowest risks, but well, it is what it is. All right, so the features of a money market fund are the opportunity to grow your capital and generate regular income. Like I said, it's a low-risk investment, so it leads to capital preservation. It has a weighted average maturity of 90 days, which means that the duration for the securities within for the maturity duration of securities within the fund is 90 days. Liquidity with easy access to your investments. The affordable entry, I've spoken earlier to the fact that investments are as low as, entry is as low as 1,000 Naira. Competitive returns, which are typically higher than savings accounts and call deposits. They give quarterly dividend payments, and they must be rated by a SEC licensed rating agency. Now, the rating agency, the good thing about that is that the rating agency will then typically tell you all you need to know about a fund, taking it from the risk, the style of the risk involved, the kind of assets that typically the kind of assets that it invests in, and so on and so forth. So the key facts are market share. So the money market fund continues to lead in terms of market share in the mutual funds industry. It currently maintains 41.2% of market shares at September 2022, or 568 billion Naira. Unit holders in demand for money market funds have grown by 191.5%, from 240,000 odd unit holders in December 2021 to 700,000 unit holders in July 2022, which again lets you see that there's a lot of value that the investing public is seeing in the money market funds. And these are some of the things that Mr. Anodele had alluded to when you are typically investing in treasury bills, commercial papers, and other forms of investing in short-term investment instruments. So, asset allocation. The assets to funds are invested 100% in permissible instruments with term to maturity at the date of acquisition of the fund manager of not more than 1 year. So that is treasury bills, commercial papers, and of course, bank deposits, because you know that we have to keep a bit of the, we have to keep a portion of the fund quite liquid to ensure that we can meet the demands, the in and out demands of the investors. So while asset allocation within the fund is subject to a fund manager, there's a minimum of 25% of the fund that must be invested in government securities, right? And then with a maximum of 5% that can be invested in other funds, and 20% in a group of funds. So you see earlier, we had spoken to, I just mentioned funds of funds. And so money market funds can invest in other money market funds and also invest in a group of funds. Next slide, please. So we look at risks and mitigants. So the risk of an investment being affected by market trends. So these are, all right, so we all know that every investment in Nigeria, every investment we make actually is subject to market trends. And the money market fund is no different. And why I'm saying this is that people tend to believe that like T-bills and CPs that there's a guarantee. There's no guarantee in investments. There's no investment that gives you a guaranteed. There's no guarantee in funds. So because of that, there are risks of an investment being affected by money market funds. And these are mitigated by investing in a mutual fund that contains a diversified portfolio of securities to balance the portfolio's risk-reward ratio and associated market risk efficiently and effectively. And so, again, like I said, you can look at the fund fact sheet and it speaks to what the holding, what the asset allocation is. It can also additionally speak to the philosophy of the fund manager, and it will let you know how risky the fund is. Mutual funds are not guaranteed or assured return products. So investors should be aware that investing in a mutual fund, there's no guarantee to any income distribution. Likewise, there's no returns on capital appreciation, and this will help manage investor expectations. I remember, and I know about, was it 2 or 3 years ago when we saw the markets for short-dated investments where we, at a point in time, we're getting negative yields on T-bills in the market. At that point in time, you then understand why we are saying this, that there are no guaranteed returns. And also at that point in time, a few of the money market funds didn't distribute, because that's just what happens with market trends. And money market funds are not immune to the market trends. Past performance does not guarantee future performance of any mutual fund, including money market funds. So investors should build a portfolio that matches their investment objectives, regardless of the short-term performance of the mutual fund. So especially as mutual funds are subject to market trends, this would tend to happen. The performance of any mutual fund is dependent, amongst others, on the experience, knowledge, expertise, and investment techniques through a process adopted by the fund manager. If you're not satisfied with what you read from the fund manager, you can ask for the risk rating. The risk rating from the rating agent will also capture this for you. And it's an independent view from what you, so you can see what this is for each fund manager of a money market fund. So investors should only invest in credible fund managers that have required expertise and proven track record. So if we look at collective investment schemes versus savings, so investments remain the most viable way to productively grow your wealth, despite the rise in the minimum deposits, despite the raise in minimum interest rates of savings deposits to 4.65% as a result of the MPR, the monetary policy rate, which and even with the current inflation of 21.29% year on year, the positive impact that hampers the positive impact or neutralizes any possible gains that savers might have made possibly. All right. So in a nutshell, keeping your money passively generates negative returns for you. If you don't, I have this thing I say to people that if little drops make a mighty ocean, no matter how poor the returns are, save your money. But then in these times where we are striving for the democratization of wealth for our citizenry, we need to all be able to take charge of creating and effectively managing our wealth, and we need to start saving our money. And that is why I guess the FMDQ has taken it pertinent to have this series of webinars that they're having around investments, retail investments. So in a nutshell, keeping your money passively generates negative real returns for you, and the best way to change this narrative and invest. Therefore, mutual funds avail a great opportunity to put your money into productive use and earn great returns. Even though we state good returns, but the returns can be great depending on the mutual fund that you choose. So the number of, I've spoken to the fact that the number of collective investment schemes unit holders has grown by about 112% in the last 28 months, from 430,000 unit holders in December 2019, this is in Nigeria, to 911 unit holders at the end of June 2022. While this seems impressive, stakeholders need to do more on policy development, mass sensitization, and a lot more to promote the capital markets inclusion. And this is something that the FMAN has taken on to work with all capital market operators and the regulators to ensure that this happens for our investing public. All right. So pre-investment considerations, let me just speak to. So you can register, you can request for your registration status from fund managers, status of the fund managers. All right, so you can check this from two places to understand your fund manager. One of them is the SEC website, which is www.sec.gov.ng, and the other is the FMAN's website, which is www.fman.com.ng. We can also call the FMAN, the phone numbers are here, all right? And then you can confirm that mutual funds are, you need to then confirm that mutual funds are registered with the SEC. And you can confirm again on the SEC website. Please ensure this because, you know, in this day of age of Ponzi schemes and get rich quick schemes and the promise for the alpha that is not that is not natural. You need to ensure that whatever you're investing in, whatever scheme or whatever fund you're investing in, should be registered with the SEC. Confirm that the account number provided by the fund manager is a custody account. Now, let me explain that. So every time you invest in a fund, the money goes directly to the custodian, the fund custodian. And when it comes out, it leaves the fund custodian and comes back to your account. You have to ensure that these funds, that account is the fund custodian's account. It will typically have the name of the it will typically have the name of the fund manager and the name of the trustee on the fund account, typically. All right. And you also need to know your trustee company. You need to know the trustee company. The trustee company is your representative in the mutual fund. I'll give you an example of what I'm speaking to. For every time that a fund manager invests in a bunch of securities, they would inform the trustee company, and the trustee company ensures that the investments are made in accordance with the trust deed. Every time the investment company wants to change the allocation of the mutual fund, it will inform the trustee, and then it will inform the SEC, seek permission to change the allocation of the. So the trustee company is working for you, the investors. Know your trustee company. They are open to you with this new age of digitalization. A lot of them are very digital, and it's easy for you to speak with them. All right. So the investment process. So again, the process is that you visit a SEC licensed fund manager for more guidance. You can go to the websites that I've spoken to before. Visit their respective websites and make sure and also visit the SEC website and make sure that they are registered. Note that the FMAN publishes daily prices of registered mutual funds in this day newspaper. And this information gives you the performance of the fund, net asset value, and so on and so forth. And then our members, the channels of investments. So our members have various channels for investing in mutual funds aimed at easing the client onboarding experience and investment tracking, fostering financial literacy. And some of these channels include mobile apps, USSD platforms, web access, web platforms through their website or internet platforms, strategic partnerships, and fintech enablers. Now, I would like to just speak to fintech enablers because in this digital age and with digital penetration from mobile phones and internet penetration, it has become a lot easier for you to invest in mutual funds. It is so much more easier now for you to pick up your mobile phone, go to the FMAN website, go to the SEC website, or read the newspaper, look for a fund manager, or you can also go through fintech enablers. There are a few fintech aggregators who host mutual funds on their platforms, and you can invest through them. And you can also be onboarded onto the fund managers, into the collective investment scheme through these fintech enablers. Now, I know that time is short. Like I said, I wanted to give us time, so I will stop here. And then I guess we can go into questions and answers. I hope that I've done you justice with just taking you through the process of the mutual money market funds and how to invest.
Thank you so much, Mr. Mokrede. I know I picked a thing or two from your presentation. So thank you so much. I think you did absolute justice to it. So to the audience, could you please, if you have questions, could you just use the question and answer field, and we'll pick up your questions from there and direct them as required to presenters today. There's one comment there, first of all. Thank you, Badipo. Yes, we will be sharing the presentation slides with everyone on the session today. So you can be rest assured you'll get that. Again, if you have any question, please could you drop that in the Q&A field, and we'll direct them to the presenters. So while you're getting that ready, let me just throw one question to the presenters very quickly. What kind of documentation should investors just, make sure they have available? Is there anything specific, or are there just the general requirements that, or are there general requirements that would, suffice for whether they're going into a CP, commercial, a treasury bill, or a mutual fund? Or what information should just have readily available to be able to invest in any of this? Should we start with Mr. Mokade? Thank you.
Thank you. Okay. Now, in information, are you speaking to information about yourself or information about the investment?
So I'm referring to themselves. So they're preparing now. Right. They've gone to the FMAN side, they've gone to SEC, they know what they want to now do. What will be required of them to actually effect such an investment?
Thank you. So currently, there are the basic KYC information, which is information about yourself, your ID card, your means of identification. We would typically also ask you for your utility bill, and you fill in a form. But then also note that because of the age of things like BVN, and also the tiering that comes within the KYC. So we have tier 1, tier 2, tier 3. The higher your tiering, the more KYC you have to put in. So if you're a retail investor and you come in and you're investing as low as 20,000, the KYC is smaller. You do not have to bring in a utility bill. Well, these are subject, I guess, to the companies, but you do not have to bring in a utility bill. And as your KYC goes up, you start to bring in the additional information. So it's very basic. Now, again, like I said, because a lot of us have now started to introduce digitization, technology, it is very easy for you to come onto our website, come on through your telephone, through your mobile phone, and then register with us. What would typically in those days, that the days that Mr. Nodele was speaking to, would take you a 1 week, 2 week, now can be done in 10 minutes. So it's very easy to access.
Thank you very much for that. Mr. Nodele? And you're muted. Okay.
Yes, I did that. I believe it's more or less touched on it, that chances are investors today will either, or most times are with banks already, even if it's a regional bank or a fintech, some platform. But let's even say that we strangely find the people that you say are in some vocation. Chances are they are members to some association. So they easily will know how to walk up to the banks and all that. So all of these are possible, and because we have agents, nobody goes to central bank directly. They will not also be able to go to SEC for any clarification directly, other than visiting websites of FMDQ, SEC, FMAN and all that, or the banks themselves. But they usually can speak to their bankers. They usually would have somebody they relate to. The monies must be somewhere. Even if they have cash today, they will go on and enter into a bank, which they can be well advised. Either if they can't be done at the branch level, there are standardized forms, they will give them the minimum. And then they can advise them through the branch to the central treasury and all that. So I believe it's quite simple. And the main thing we have enjoyed today is the fact that it's as easy as from your mobile phone, And I believe some are so easy that you don't even have a smartphone now, you can still get to make an investment. So it's just for them to have this awareness, and because it can be tied to a BVN or NIN or whatever. So I'll say it's pretty much easy. But people can always ask for more information from websites and bankers, brokers.
Thank you very much for that answer. We have a question, and I think obviously this is directed at Mr. Mokade because it's on mutual funds. So Mr. David Ayano wants to know, as an individual who intends to invest in mutual fund, how can one guaranteed returns better than other investment portfolio? Okay, Mr. Ayano, I hope we understood your question appropriately. Should I modify the question to say, do they guarantee returns better than other investment portfolios? Perhaps that's the question. Thank you.
All right, thank you. Like I had spoken to earlier, it would be to say that it's a guaranteed return for a mutual fund would be wrong. And so it's not a guaranteed return. However, the very nature of a mutual fund says that, look, I have 10 million naira, or I have 100,000 naira, I have 10,000 naira. Okay, take someone who has 8,000 naira. You go to your bank and you put it in your savings account and you earn the minimum 4.65% return. Or you put it in a mutual fund that has the same characteristics of a savings account, like the money market fund. And the typical money market fund now is returning about 12% per annum, averagely. And so clearly, there's a great advantage to put your money into that fund and getting a better return from that fund. Again, there's easy access to the money market. So it's easy access for you to enjoy the value that you would get from investing when you do not have the minimum requirements to invest in a CP or in a treasury bill. You are getting the same value back. In fact, possibly sometimes, depending on the scale of the fund manager and the objectives of the fund, you can get a better return than what you would do if you went in yourself typically. And so you're enjoying a lot of value from research, from investment expertise that you would find difficult to put in yourself, and you're getting that value at a minimum investment opportunity.
Thank you very much. So you're getting premium advisory at fraction of the cost on that one. Okay, so let me ask another question to both presenters. Are there any restriction whatsoever that retail investors should get to know about with regards to these two products categories, commercial papers, treasury bills, and of course, mutual funds? Could they go into any of these offices and hear a restriction that they probably hadn't heard of before? Does this exist?
Let me go first. I think, as noted during the presentation, for the commercial paper, there will be restriction if it's not a guaranteed commercial paper for the retailer now. And that is also to ensure, it's like somebody saying, because there are good returns on derivatives, I want to jump into it. The first thing is we need to profile you. Do you really understand? So, and I think what the regulator and even FMP is trying to do is, yes, everybody could have just come in to invest, but when something goes wrong, that's where you now start hearing different. So to avoid that and to give the right people who are quite clear, which is why you then even say for the QRs, you have to have a declaration. So if you write in black and white, you signed it, it meant you knew what you were doing, because the risk is there should there be a default. But where it's guaranteed, it is supposedly saying there could be some comfort unless, force majeure and what have you, there will always be a backstop line, somebody willing to put their share on the line, their name on the line, no reputation and all that. So that's what I would say. Other than that, there shouldn't be restrictions, except also for maybe the minimum entry level into the investments. So again, also, I think because the federal government had wanted to push the investment in FGN savings, T-bills before used to be as little as 10,000 naira or so, and then in multiples of 1,000, but now they've raised it to 50, which then showcases where the likes of Mr. Aviosu's members will then be able to help. So if I'm a retailer, I can't do 50 million at 1,000. Definitely, the CPs on the Israel side says 100 million multiple of 50, but it doesn't say you can't invest there. So if you want to participate, the best way to go is in the fund, go into the pool, partake in everything. And, you might even be guaranteed some fund managers may even then tell you, set a threshold for your yield. If it's okay to you, it means they'll pay you that. Even if the fund didn't do it, means they're underwriting the yield you're going to get. So I think that those are basically the issues, other than your own risk profile and tolerance level.
Thank you for that. Mr. Market, any restrictions for money market fund type investments?
No, there are no restrictions. Mr. Nadele has said it already. There are no restrictions. And I'm happy that he mentioned that. So when the federal government decided that it was doing the national savings bond, which is the retail bond that gives you a return typically of between 12 and 13, well, at the time, but it's a minimum of a 2-year, and there's a 2-year and a 3-year program. and they moved us into the retail into that space. It gave the opportunity, more of an opportunity for us in the mutual funds, mutual funds, fund managers industry to come up and showcase what we can do for the investing public. But then again, there are no restrictions. I've spoken to that. You come in, there are no restrictions. It's so fluid now that you can start your investments in 10 minutes.
Thank you. I mean, I think that takes us very nicely into the next question Mr. David had. He asked, how could the cooperative society invest in mutual funds? I think I can answer that from all that has been taught today. Mr. David, you simply just need to get in touch with FMAN, get details of a fund manager, make your choice, review what they have to offer, and make contact with that fund manager to set up the necessary accounts. Mr. Mukade, is that right?
Correct, madam. Correct.
Yeah, it is very, very simple. And we'll be sharing the slides with you. So of course you can get the details of the Fund Managers Association on the slides as well. Okay, any other question in the house from anyone? Okay, I'll just let the presenters 1 minute, well, 30 seconds if possible. What are your last words to retail investors there? And then we'll just round up the session there. Mr. Nade, you're muted if you're talking.
May I claim your indulgence to go first so that
all right. Yes, please go ahead.
Round things up as yourself. Well, I know at the moment in the country we seem to be going through some tides, but the man or the investor who chooses not to save is the one that will have problem. Yeah, because in terms of real returns, everything seems to be negative. Even if you look at your pension now, it's all like the negative, but at least you've got to make an effort in trying to invest. And depending on how sophisticated investors are, that is when you can even start to say, oh, I'll start crossing border. But the minute you also start doing that, you are undertaking some risk that may not, end with being localized risk or immunized to the local scene. So I would just encourage everyone to hang in there, continue with the habit of saving. There's always the silver line at the end, the rainbow, as they say. We just have to keep trying. At some point, the market is going to come back. As they say, market will always repeat itself. The minute we get the dynamics back again, this same market will be the attraction where even the people from outside want to come and invest, and all that. So I believe it's just for all these economic indicators to start adjusting. What we're going through now in terms of yield is global, so it's understandable, but then we should still have the dynamics to address the major issues. And it all starts from leadership, governance, and all this we're going through. Maybe 2023 will be the reverse we need in the right direction. So be encouraged to continue to save.
Thank you, Mr. Nodeli, for that chat. Mr. Makade, your last words?
Thank you. Now, just going further from what Mr. Nodeli said, it's very true. You just need to continue to save. But then also note, and he touched on this point, that as you start to save and as you start to grow your wealth, because whether you like it or not, when you save, you grow wealth. At least at the minimum, you keep your wealth. You start to see the other opportunities in the capital markets, in the fund management, in the investment management stream, and then you speak with fund managers, you speak with asset managers, you speak with professionals, and you continue to educate yourself. Continue to educate yourself because there are a lot of opportunities, and you'll find out that even as we start to bring out from an industry perspective, as we start to bring out more innovative products that will help to allow you to have diverse asset classes and investment opportunities, which we will do. You also need to, the onus is also on you to have a fair understanding of what you're doing. The educated mind is the one that wins.
I think we could not have ended on a better note than that word. The educated mind is the one that succeeds. Thank you so much, Mr. Mukade and Mr. Nodeli, for your time, your wisdom, your in presentations today. I think it has been most enlightening. So just to close the session today, we have the chairman of the subco that is put this together for you today, Mr. Tosin Oshikoya, who is the co-managing partner, Commercial Partners Limited, to just sort of extend a vote of thanks. Tosin?
Thank you very much, Jumoke. Good afternoon, ladies and gentlemen. Good afternoon to our speakers, Mr. Tayo and Odele. Thank you very much for a wonderful delivery of your paper. Thank you also, Mr. Makwede, for a fantastic, insightful speech as well. Education, education, education. I guess everybody has said so much about education, and you would agree with me that that is the bane of every investment. That's the building block. That's the foundation. Benjamin Franklin said that an investment in an education pays a lot of interest. So not just on education, but you must also learn to apply. So education without application is an exercise in futility. So for everybody listening here today, please, we crave your indulgence that you should not just listen to what we've said. You need to begin to apply it. And we will continue to carry you along this journey. And what do I mean by that? At the DCMD, that's the Debt Capital Market Development Project Office, and the SOPCO here, our mandate is basically, engagement and enlightenment of the investors, the issuers, and the intermediaries. And we will continue to do that. This session is the second series out of many series that will be coming up into next year. And one of the things that we've highlighted for ourselves is the fact that we need to continue to engage the public, the investing community, and not just the investing community, the issuers community and the intermediaries as well. So today, it's just one of the things that we are meant to do. It's our responsibility to continue to educate you. You would also agree with me that this line of, or this form of education, it's not just the only one we should be looking at. So at the SOPCO level, one of the things we've devised, or one of the strategies that we've devised is the fact that it will go beyond the traditional assets, traditional classroom-like, education, and complements that with leveraging on social media. So we've developed a few contents that will be dissipating into the market, into the investing community. Please, you can share your email addresses with us so that we can send some of those contents to you. In addition to leveraging social media, we also thought that it was important for us to have a timeline, and we're contemplating on this. There have been one or two discussions around looking at audio and visual platforms to communicate to you and to disseminate some of these information to you. So you can imagine if you are in traffic, for instance, and you get some sort of education or market enlightenment about some of the things we've spoken about today, the investment options in the debt capital market, or the mutual funds by Mr. Imokwedi, and you are in your car listening to it, it relieves the experiences you've had today. So we're not just limiting it to the classroom-like education that we've done today. Yes, we will continue in this line, but in addition to that, we will leverage social media. Not only social media, we will also leverage audio and visual media as well. So please look forward to that as we continue to carry you on to this journey. One other thing is that you would agree with me that what we've discussed today is very topical in the sense that as we move into 2023, a lot of investors are beginning to get apprehensive of the 2023 year, which is our election year. 2023 is plagued with, political risk, and obviously because of the election, and not just because of that. The rising inflation rates and the rising interest rates are two major items and variables that investors right now have to consider in any kind of asset classes they want to invest in, especially the tanking asset prices. Asset prices, particularly this year, they've tanked by almost 50 to 80%, depending on where you're investing in, whether it's local or in foreign asset classes. And it is our responsibility at DCMD Project Office and the SOPCO hand-holding every member of the investing community on what you should look out for. I'm sorry about that, on what you should look out for when you are making an informed decision or when you are investing any of your funds in all these asset classes. Next year, some of us are looking at how the federal government are going to manage the budget deficit. So you have a budget deficit of about 10 trillion. That is the highest or the largest deficit we've had, all-time high. And if you look at what has been happening in the international capital market, especially within the SSA, the sub-Saharan African market, of course, if you allow me to mention, particularly in Ghana, it limits the capacity of any other, sovereign within that space in Africa to come to that market to borrow money. What that means is the debt management office might begin to look for other alternative avenues of raising capital or raising money to fund the deficit. That limits them to possibly, or to a large extent, coming into the local markets to raise finance. So you can imagine your guess is as good as mine. If you have a rising inflation, you have a rising interest rate, and you have a government that is willing or should be borrowing as much as 10 trillion, even if they want to borrow 70% of that, which is about 7 to 8 trillion, that is still a lot of money. Year to date, I think they've raised between 2 trillion in terms of coming to the debt market. So you can imagine how much they're going to raise next year. That only points to one direction, that we might continue to see interest rates on the rise. So for investors, that portends a lot of opportunity in some of the asset classes we've discussed today. And that's why we will continue into 2023 to take you through this journey and ensuring that, yes, you get good return for your monies. So without saying too much, because I know that we've really spent so much time here, I would like to say that please, you need to continue to pay attention to some of the communications coming from us, because what we've observed is we've been on this journey for some time now, and we've not seen significant participation. I think attendance today really could be better than what it is now. So for some of the professional bodies that we've written to, particularly the CIS, FMAN, and ASHAN, please, we charge you to call on your colleagues and your customers as well, your clients, and let them be part of this as we move into 2023. 2023 is going to be an interesting year. If you want them to enjoy 2023 and not be on the bad side of the coin in terms of really getting cane with the markets, you need to bring them on board with this series of market enlightenment and engagement. It is very, very important. So on a final note, I'd like to thank our speakers. I'd like to thank Mr. Ike Mokwede for a wonderful delivery of the mutual funds in Nigeria, evolution, trends, the dynamics of that space, how you can benefit from it, the structure, the risk, and the mitigants. I mean, all of that, you were very, very insightful. Your presentation was insightful, and thank you so much for that. I'm sure we can always call on you from time to time to talk more on how, going into 2022, what investors should look out for, not just on money market, but also maybe on dollar funds, other mutual funds, on dollar funds, on fixed income funds as well. Thank you very much. We really appreciate your time. Mr. Tayo Onodele, you're not new to the family. We thank you so much for a rewarding and interactive session as well. We know we can always call on you. Thank you so much for your time. Jumoke, a wonderful anchoring. Well done as usual. And to everybody out there, please let us enjoy the Christmas period. And please, as we move into a new year, like Mr. Ike Mokwede advised earlier on, and Tyler as well, you need to stay close to a professional. Let them handhold you. Let them take you through the turbulent time that we might experience in 2023. Thank you all for your time and have a wonderful day. Bye.
Thank you very much, Chair. Thank you, everyone, and we look forward to seeing you at the next series. Thank you very much, everyone. Have a good afternoon. Bye, everyone.